So we were doing problem number 19. So in 19th problem, we have completed. If 100% dividend payout ratio, then market price per share is 100 rupees and the value of the firm is 1 crore. Similarly, case 2 in 100% retention. If 100% retention means DP ratio is 0, dividend is 0. So price per share is 200 rupees and the value of the firm is 2 crore. 50% dividend. So 50% of 10 rupees is 5 rupees. So D is equal to 5, market price 150 and the value of the firm is 1 crore 50 lakhs. So this is the end of the problem number 19. See the problem number 20. 20th problem, relationship of dividend policy and the value of shares according to Gordon's model. So here it is given A, company A, B, C. R is equal to rate of return on investment, IRR. IRR 0.3, 0.2, 0.15. KE, cost of capital 0.2, 0.2, 0.2. EPS 5 rupees. Find out the effect of dividend policy on market value of the share according to Gordon's model when retention rates are 40% and 60%. Already this type of problem we have done earlier. Now it is given according to problem number 20. According to Gordon, P is equal to E into 1 minus B divided by KE minus BR. This is the formula we'll apply. Now in order to make the calculations, it is better to make the table. Only structure I am showing, remaining calculations you have to do it yourself. Companies A, B, C, 3 companies. Now R is equal to, the internal rate of return is 0.30, R is equal to 0.20, here R is equal to 0.15. This is the information given. Now case 1, if retention ratio is 40%, retention ratio is 40%, so B is equal to 0.4. Similarly, case 2, retention ratio is 60%, so B is equal to 0.6. That's all. Now simply you have to substitute the values. P is equal to E. The earning per share is 5 rupees for every company. 1 minus 0.4 divided by KE. The cost of capital is 0.20 minus B into R, 0.3. Similarly, P is equal to 5 into 1 minus 0.4 divided by 0.20 minus 0.4 into 0.2. Similarly, P is equal to 5 into 1 minus 0.4 divided by 0.2 minus 0.4 into 0.15. Like this you have to calculate. Here B, P is equal to 5 into 1 minus 0.6 divided by 0.20, 0.6 into 0.3. P is equal to 5 into 1 minus 0.6 That's all, completed. Only calculations are required. Company A, case 1 is 37.5 and case 2 is 100. Then B company 25 and here it is 25. C company 21.43, here it is 18.18. Make the calculations and check the values. Already so many problems we have done on Gordon's model, Walter's model and Modigliani and Miller model. See the next problem. 21st. The following information is available in respect of PQR Limited. EPS 10 rupees, cost of capital KE 10%. Find out the market price per share under different rates of return ratios. 8%, 10%, 15% for different payout ratios, 30%, 40%, 60% and 80%. Nothing is given regarding which method we have to apply. Whether Walters model or Gordon's model, nothing is given. So the better method is Walters model. By using Walters model, you have to find out the value of the share under each of the different situations. So here just a structure I am showing. Remaining calculations you have to do it yourself. So it is 21st problem. E is equal to rupees 10. Then KE is equal to 10%, 0.10. Then we are given, find out the market price per share under different rates of return ratios. So R is equal to 8%, 10%, 15%. And DP ratio, payout ratios are 30%, 40%, 60% and 80%. So according to Walter, P is equal to D plus R by KE into E minus D divided by K. This is the formula for Walter. Now, make a table and find out. Like this table you have to make. Internal rate of return. R is equal to, here 8%. 0.08. Here R is equal to 10%. 0.10. R is equal to 15%. 0.15. Then we will have case 1. DP ratio how much? 30%. So D is equal to 30% of E. D is equal to 30% of 10. D is equal to 3. Similarly, case 2. DP ratio is 40%. So D is equal to 40% of 10. D is equal to 4. Similarly, case 3. DP ratio is 60%. So D is equal to 60% of 10, D is equal to 6. Last one, case 4. DP ratio is equal to 80%. So D is equal to 80% of 10, D is equal to 8. That's it. Simply P is equal to D. How much is the D here? 3. Plus R by KE 0.08 divided by KE is 10%. 10 minus 3 divided by 0.10. Like this you have to make the calculations. Already we have done so many problems. You know how to calculate. Right? Last and final problem. See the last and final problem, 22nd. Sunrise Company Limited has an EPS of 20 rupees, IRR 20%, cost of capital KE 15%. Find the market price of share at 20%, 50%, 80% payout ratio. Will there be any change in market price if IRR become 12%? Which payout do you advise under both situation conditions under Walters model? So here 22nd last problem. EPS, the EPS is rupees 20. R is equal to internal rate of return 20%, 0.20, and KE, cost of capital, is 15%. Find out the market price if the payout ratio, DP ratios, dividend payout ratios are 20%, 60%, 50%. 50% and 80% payout. Then will there be any change in market price if IRR become 12%? वो तो बाद में लेंगे. First of all we calculate for this one. According to Walter, P is equal to D plus R by KE, E minus D divided by K. So first case 1, DP ratio is 20%. So D is equal to 20% of rupees 20. D is equal to rupees 4. So P is equal to 4 plus 0.20 divided by 0.15 into 20 minus 4 divided by 0.15. P is equal to rupees. First bit over. Now second, case 2. DP ratio is 50%. D is equal to 50% of 20, that is equal to 10. D is equal to 10. P is equal to 10 plus 0.20 divided by 0.15 into 20 minus 10 divided by 0.15. P is equal to rupees. 2 cases over. Now third case. DP ratio is 80%. So D is equal to 80% of rupees 20. 16. So D is equal to 16. P is equal to 16 plus 0.20 divided by 0.15. 20 minus 16 divided by 0.15. So P is equal to rupees. So we have calculated for all the three. Here 20 minus 4 into 0.2 divided by 0.15 plus 4 divided by 0.15, it comes to 168.89. Then here 20 minus 10 into 0.2 divided by 0.15 plus 10 divide by 0.15, 155.56. Here it is 20 minus 16 into 0.2 divided by 0.15 plus 16 divided by 0.15, 142.22. That's it. So we have calculated, first part we have completed. The second part is, will there be any change if the market price is, if the IRR becomes 12%? If the IRR becomes 12%. R is 0.12. So again we have to calculate case 1. Case 1, P is equal to D, 4 rupees. R is 0.12 divided by 0.15 into 20 minus 4 divided by 0.15. P is equal to rupees. Then case 2. P is equal to, here case 2, D is 10 plus 0.12 divided by 0.15 into 20 minus 10 divided by 0.15. Then case 3, P is equal to 16 plus 0.12 divided by 0.15 into 20 minus 16 divided by 0.15. That's it. Only internal rate of return we have changed. Earlier it is 20%, now it is 12%. So 20 minus 4 into 0.12 divided by 0.15 plus 4 divided by 0.15. 112. It is 112. 20 minus 10 into 0.12 divided by 0.15 plus 10 divided by 0.15. 120. 20 minus 16 into 0.12 divided by 0.15 plus 16 divided by 0.15. 128. Which payout do you recommend, advise under both the conditions using what? Ultimately, it is asking you to give the suggestion which payout ratio is better. So in the first case, when the IRR is 20%, when the internal rate of return is 20%, when DP ratio is 20%, 168.89. When DP ratio is 50%, 155. When DP ratio is 80%, 142. Now compare which market price is the highest. 168, 155, 142. So if we compare these three, the highest market price is 168.89. At which DP ratio? 20%. So first conclusion, when the internal rate of return is 20%, the appropriate DP ratio is 20%. Because when DP ratio is 20%, the market price per share is highest 168. Now come to 12%. If the internal rate of return is 12%, in that case 112, 120, 128, which is the highest market price? It is 128. So if the internal rate of return is 12%, the appropriate DP ratio is 80%. It is 80%. So you have to make the conclusion. When the internal rate of return is 20%, the advisable DP ratio is 20%. The advisable DP ratio is 20% because in this case the market price is highest. Now second conclusion, when the internal rate of return is 12%, in that case the advisable DP ratio is 80%. Advisable DP ratio is 80% since in this case the market price is highest 128. That's it. So we have done the problems on, so many problems we have done on dividend policy. Mainly the problems are on Walter, Gordon and Modigliani and Miller. So be thorough on the theoretical concept apart from problems. For Osmania University, particularly examination point of view, they will give you the theory question regarding explain the factors which should be considered while declaring the dividend or declaring the dividend policy. What are the factors to be considered? So theory session we have discussed external factors, internal factors. These are the factors you have to be thorough. Apart from that, what is the meaning of the term dividend? What is the nature of dividend policy? And what are the conflicting theories regarding dividend? Conflicting means irrelevance theory and relevance theory. Irrelevance theory was propounded by Solomon and Modigliani and Miller. There is no relationship between dividend policy and market price, valuation of the firm, independent completely. Whereas the relevance theory supporters was James Walter, Myron Gordon, Richardson. These are the persons who are the supporters of relevance theory. They says that dividend policy will have a direct impact on the market price per share. So it is the responsibility of the finance manager to make an appropriate dividend policy so that the market price per share will increase, the wealth of shareholders should increase, the value of the firm should increase. So these are the different theories. So we have done the problems also. Modigliani and Miller. Modigliani and Miller is the supporter of irrelevance theory, and he has given the theory that the market price depends on the investment policy and the profit potentiality, not upon the distribution of dividend. But his theory is based on some assumptions, and those assumptions are not practical. Like capital markets are perfect and the investors are rational, no transaction cost, no flotation cost, and the investors will not make any distinction between dividend income and capital gain. Risk and uncertainty is not there. These are the assumptions given by Modigliani and Miller. That's why his theory was rejected. In reality, these assumptions will not satisfy. Okay. So we have completed 4 parts of this unit number 4. That is cash management, receivables management, inventory management, working capital management, and dividend policy. 5 parts we have completed. So this marks the end of unit number 4, the lengthiest unit. सब में बड़ा unit number 4 है, and that we have completed. In the next session, we will take up the last unit, unit number 5. That is corporate restructuring and corporate governance. So inshallah, in the next session, we will discuss more about unit number 5. But have a good command on this unit number 4. Unit number 4, not only from theoretical point of view, but also from practical point of view. Again and again you listen, you see the lectures. Then definitely it will help you not only for your examination point of view, but also for your career. Okay, bye-bye.